So in today's video, I am going to talk about a case of an individual who had recently reached out to our company, and he had a pretty clear picture of what he wanted to do with the whole life insurance policy. When he had reached out, he had provided the dollar amount. It was a range with respect to how much he wanted to pay into a policy each year, the number of years that he wanted to pay into a policy, and then that he wanted to use the policy specifically for his business. However, as we communicated via email and then over a Zoom call, there are some things that we definitely wanted to make him aware of, really to avoid any kind of mistake or buyer's remorse. Meaning seeing an option that looks shiny in terms of a product, but then only to find out after the fact, hey, there's a better option that exists. Or by the way, things will work beautifully if you stuff the policy each year. However, Mr. Business Owner, if we pick this high-end option, but we're unable to fund it at the amount that we think we can, well, here's what it looks like. And it's not as attractive. So I'm going to go through the different options that we had shown him. And if you're interested in a whole life insurance policy, you're trying to figure out what should I be looking at in terms of different options. I'm looking at a large dollar amount going in. Hopefully this video helps and applies to your situation. Let's get on into it. So to begin with some details at the top left, we've got a 42-year-old individual. He is an engineer or engineering background, so very good with numbers, likes the technical details, and wants to see everything regarding the options. Actually, before we connected over a Zoom call, I had sent him a number of scenarios and detailed illustrations, and he had actually let me know during our Zoom call that he had read through all of the full illustrations. So he's really going through it with a fine comb to make sure everything's set up how he wants, and he can ask questions about items that he does not understand. He is a business owner, and he is in the business of transportation logistics. So some very complex stuff there. Very sharp guy. Now again, when he reached out, he's interested in a whole life insurance policy, knows exactly what he wants or has a very good idea as to what he's looking for. High cash value is the focus, and here we go. So first thing he's looking for, or that he mentions regarding the funding, is that he'd like to pay in a dollar amount somewhere between $300,000 and $500,000 per year. And he would like to fund the policy for a maximum of 5 years. And internal rate of return is a focus there. How does he maximize the IRR, both on a non-guaranteed and guaranteed basis? Once he's got that policy funded, he does want to use it for business, specifically through loans. And when I say once he's got that policy funded, I don't mean after he's funded it for 5 years. He can use the policy anytime, including the first year if he wants to. The earliest one can access their cash value in a policy is typically 10 business days after I've made the initial payment. The insurance company wants to make sure that your funds have cleared from your bank account, and that everything's in good order. So, has an idea as to what he's looking for. Here's my goal. I want to help him determine the best possible option. These 3 items. 1, the funding amount, because $300,000 to $500,000, there's a range there. There's a gap of $200K, and there are some very important things that if him and I flip positions, I want to know before picking one of those options. Company selection. One of the 4 major mutual companies we always recommend. We looked at options with Mass Mutual and Guardian in his particular case, mainly for flexibility, which I'll hit on once we start going through the numbers. And then the products, I'll go through those products as well. You'll actually see this option, or this video, regarding Guardian, their Executive Strategies product, which is a great option for business owners and individuals. Really, if you're paying in or you have an intention of paying in $500,000 per year or more. Less than that, it does not always make sense, and I'll demonstrate that too. But before we hop into the numbers, something very important here I want to go through. So rules of the game, awareness of the limits. As we look at this, here's what I want to hit on, is as follows. Pretend you're him for a moment, and you're looking at option A and option B. Option A is the $300K option, meaning the maximum you can pay into a policy on any given year is $300,000. Option B is the $500K per year option. So what this means, both options, with option A, you've got the ability to pay up to $300,000 per year, but you're not committed to it. The same is true with the $500K per year option. You have the ability to go up to $500,000 per year, but again, you are not committed to it. So the most important thing here is the policy design. Where is your money going? If there's any item I want to be aware of, this is it. So looking at option A first, if $300K per year is the maximum I'm going to pay into the policy on any given year, well, money can go toward the premium or the PUA rider. How low can I go in the premium? Because premium dollars typically do not show up in cash value in the first year. They take the biggest bite out of cash value initially. So how low can I go? Well, you'll see with those major mutual companies, Mass Mutual and Guardian, just about 10% is as low as I can go. I'm going to go through the exact numbers too with the different products. What that leaves over is, call it 90%, to be allocated toward the PUA rider. PUA dollars, 90 to 95%, show up in cash value in the first year alone. This is money I can access, begins compounding. This is how I optimize the cash value on a whole life insurance product. Now, if I have a policy where I'm paying in, or I have a $30,000 minimum premium, and then I pay the other $270,000 toward the PUA rider, the numbers will look fantastic. And we're going to go through the exact numbers. Now, if you do the same thing with the below option, so you've got option B, $500K per year max, and you do the same thing from a ratio standpoint. You've got a $50,000 minimum premium. First year, same impact. However, $450,000 is allocated toward the PUA rider, which accelerates the cash value. From a growth rate standpoint, internal rate of return, break even, when we compare those two options side by side, you'll see very, very similar performance. Just this option will have more money because you've paid more money into the policy. So with all things being equal, if I actually pay in $300K per year with the option where I can pay up to $300K, or $500K with an option where I can pay up to $500K, things will look very, very similar from a growth rate perspective. Here's the item I want to be aware of. What happens if you go with option B? We should not have erased that, but that's okay. So we've got option A, the $300K, option B, $500K. What happens if you go with option B, but only pay in $300? Only fund $300K. Because this option, you've got a $50,000 minimum premium. We need a higher death benefit in order to obtain that MEC limit of $500K. In summary, we have higher expenses on this policy, and the reason we have those higher expenses is to have the ability to pay up to $500,000 per year. If you max fund it at $500K, that more than covers the expenses, and it's worth it going with that higher end option. However, if I pick option B because I think I can hit it, but never hit $500,000, how much does that hurt me? That is what I would want to know more than anything else. Because where people have buyer's remorse when it comes to whole life insurance products is rarely on how loans work and using the money and such. It always has to do when one takes out a whole life insurance policy, high cash value was the goal, but they find out after the fact the policy could have been designed differently, they could have went with a different product, different company, whatever it might have been, and that other option that they see after they've already started a policy would have given them more money. So let's look at some options here. What we'll begin with, you'll see this on the bottom left-hand corner when we look at the Excel workbook. First one, $500K. Then we've got $300K. And then we're going to look at what-if scenarios with the different products. These are the most important things to look at. So beginning with the $500K option, what you'll see on the left, Mass Mutual 10-pay policy. Breakdown as to where the money is going. Here we've got $500,000 per year going into the policy for 5 years. That's a total of $2.5 million. Base premium, $50,000. Total outlay, $500,000. First year cash value, $446,000, almost $447,000. Death benefit, $7 million and change. Annual internal rate of return. This is the net growth rate. What is the worst year about any whole life insurance product? The first year. I pay in 500 grand. I've got 446 in cash value. No matter how I slice that, that is a negative hit of 10.68%. I took a loss. Second year, he pays in $500,000. The same minimum premium of $50,000. That minimum premium will not change. Cash value was 446, grew to 928. If it was a 0% bank account or mattress, and I had 446 and I added 500 to that 446, I'd have 946. I have less than 946. It's a negative annual internal rate of return of almost 2%. Now, beginning year 3, finally starts to pick up the pace, paying 500K. I get my 500K back, plus another 20K on top of it. There's the annual internal rate of return, 1.42%. Next year, paying 500K, really picking up the pace now. Look at that. I've paid in, why I'm highlighted in yellow here, it's because by year 4, I've paid in a total of $2 million, and I've got just about $2 million, 1.995. That's why this average internal rate of return is almost 0. I'm slightly negative by a little bit more than $5,000. And by year 5, I am positive by $70,000. So there's the annualized internal rate of return, which isolates what the policy grows by each year. These are all based on the present dividend rate. Things will change over time. And then you've got the average internal rate of return. This is a MassMutual projection. Then you've got 2 Guardian policies. You've got the L95 product, which means you can pay into it up until age 95 if you want to. With the L95 product, we can set the base premium at this dollar figure, $45,000 and change. Where we came up with that dollar figure, I'll walk through in the illustration shortly, rather than explain it through the Excel workbook, but we've got it minimized. 500K premium, biggest hit up front on this option compared to the other 2. Hit up front is a little over 16%. So I pay in 500, I've got 418 in cash value. Next year, I pay in 500, I get almost all of it back. Still negative, not quite as drastic though in year 2. And beginning year 3, I pay in 500, grows from 911 to 1419. So I got my 500 back plus another $8,000. That's why I've got a positive IRR, a little over 0.5%. What's highlighted in yellow represents the break-even point. I've paid in $2.5 million. I have $2.5 million. Then I pay in 0, and the cash value continues to grow. Executive Strategies product. So let's hit on this, and then we'll go through the detailed illustrations so you can see some of the moving parts here. 500K per year. Base premiums at 100K. This product is not for everyone. The minimum base premium requirement is $100,000 per year. There is an exception to that if policies are being purchased by a company on a number of employees, then those premiums can be lower for each product. But if it's for an individual, so if you're looking at a policy for yourself, for your spouse, it's just one individual, then the minimum premium on that product is $100,000. If it's for a company and there's multiple individuals that the company is taking policies out on, the minimum is lower, which we can go through in other videos. Otherwise, I'll just talk about it all day long. But here's the advantage to this product. First year, 500 goes in, you're at 462 right out of the gates. Look at that negative hit. It's the lowest, 7.6%. Next year, similar trend to the other options, break-even point between years 4 and 5, and then continues to grow over time with no payments. Both MassMutual and Guardian are solid. We've seen them always deliver strong internal rates of return. MassMutual does illustrate better right now because they've got a higher dividend rate. However, in reality, I've seen both companies deliver IRRs that are almost identical with each other. Not quite. You can't go wrong with either one of them, and I always see them go back and forth. Now, here's what I want to hit on. The difference between that L95 and Guardian Executive Strategies product. The L95 is like any Guardian policy that we talk about all the time. If you're paying in $500,000 to a whole life insurance policy, you're with the ability to do that. What I'm going to point out first is where the money's going, or what you want to be aware of. You don't have to know every detail, but here's the most important piece. If I've got $500K going in, how low will the insurance company allow me to set my premium? That's what I'm committed to. This way I can make it very, very flexible. I'm not billed for $500,000 each year. I can commit, it's to the minimum premium, plus this $3,000, almost $3,100. This is a cost of a term rider. Purpose of adding term insurance to a life insurance policy is it's a cost-effective way to add more life insurance to the policy, which in turn is a cost-effective way to raise your MEC limit on a life insurance policy. How do I get the death benefit high enough to obtain the MEC limit I want? And how do I get the death benefit up at the lowest cost, which in turn gives me more cash value? So the true minimum is the base premium plus the term cost. If we round off, call it $50,000. So literally, he can commit to $50K per year. This is what a lot of people we work with do. They commit to a minimum amount and then pour everything else into PUAs on an unscheduled basis. But this is the L95 product. Here's what I want to hit on. Here's your Executive Strategies whole life product. This product has a minimum base premium requirement of $100,000. There's the term rider cost, $2,200 and change. So we can make it $103,000. In a case like this, we might just round off, so we're billed for $105,000 per year. Big difference. So flexibility is something that's important to you, and having a minimum premium that never stresses you out, you feel like it's never a burden, that often helps one refine the decision-making process between that L95 and Executive Strategies product, if Guardian's the way that you want to go. Just because when we look at the two long-term, if all things are done properly from a design standpoint, there's not a huge difference. The difference, though, is that Executive Strategies product does give you more upfront. So why companies like it? It minimizes the upfront hit on the balance sheet, but what it also does is commit them to a higher dollar amount, unless, again, you're using the policy on a number of employees. But main difference, higher minimum premium, but higher upfront cash value, which is nice. A lot of people like that. Quick side note to Guardian. He did select Guardian, and the reason why is with that PUA rider, it's extremely flexible, where he's committed only to the minimum premium and term rider. So that's what he's billed for each year, and then he can just add unscheduled PUAs to the policy at discretion. He can do that through his mobile app, online portal, can mail in a check. Very flexible, loves the idea of being committed to a premium, does not feel like it's a burden at all, and then throws more money into the product at discretion. Let's look at MassMutual real quick so you can see where the money's going. There's the $50K base premium. And we've got term riders and such attached, PUAs, all the goodies. But you'll see all the values match the detailed illustration. And if we look at the $300K per year option, you'll see the same thing, but everything just scaled down proportionately, with one exception, the Executive Strategies whole life product. Because when we go to the $300K option, look at these base premiums. This is the $500K option. Keep those in mind. Ready? $300K. What do you notice here? You've got $300K per year going in with the MassMutual product. Everything's proportionate. So this is a policy where you're max funding it at $300K per year. Here's your base premium. The death benefit's lower. I need less life insurance because I'm paying less money in. The maximum dollar amount I can pay in is $300K per year. Break-even point, look at this. Year 4, IRR looks good, very comparable to the $500K per year option. Here's my L95. Look at this. Base premium, 27 and change. $300,000 total. So wherever I set that base premium, we can actually illustrate 10x the base premium in PUAs per year. And then that plus the base premium equals 300K. Another way you can do it is take the total desired payment and divide it by 11 to get the true minimum premium amount we can illustrate with Guardian, with the exception of the first year, where we can pour a huge lump sum in if we want. Point is, we're back to this. Break even, still year 5. So these two, the premium dropped, meaning your commitment would be less. How about that executive strategies product? Still that minimum base premium of 100K. There's the difference right there. So this is the most important piece to hit on, because in this particular case, it's not as strong. 300K per year going in, you've got a high base premium that's closer to a 30-70 split in this particular case. So I mean, it works, but that's still a high premium ratio that I'm not quite as comfortable with. And in fact, if we compare both products here, or let's look at Guardian, same company, 2981 in total cash value with the L95. If we look at the same year 20 mark, 2924. So you've got close to a $60,000 difference there. With all things being equal, you paid in a total of $1.5 million, $60,000 over 20 years. Depends on the individual. I have spoken with some that say, that's marginal relative to the dollar amount I'm paying in. But some say $60,000, that is money that I'd rather have in my pocket as opposed to going with a higher premium expense. My point is, if he's paying up to $500K per year, that executive strategies product can work. However, if he picks the 300K max, I'd probably lean toward one of these options. It's ultimately his choice. However, we've got a higher commitment and not added value long-term, a little bit more upfront, but it's not drastic in this particular case. So let's look at option C. Remember that one? What's it look like if I take the 500K per year max, but only paying 300K? And let's begin with the L95 product. So what if I go with 500, but only paying 300? Look at the left. 500K for 5 years. 500K MEC. 500 goes in. Look at this one. 300K for 5 years. Also a 500K MEC. So here, you've got the same base premium as what we've got over here. You've got the same death benefit. This option, you have the ability to go up to $500,000 per year, but we're demonstrating what happens if you don't. How much will it hurt us? And how you get that number is we look at this option, which is 300K per year for 5 years. So you've got the same dollar amount going in. So A, let's call it A here, versus B. Which one would you want? Well, in the first year, it's pretty evident because we've got the same product here, same out of pocket on your end, but different design. 300K per year, maxing it out, breaking even year 5. Over here, it's year 6 with that higher base premium. As time passes, let's look at year 20. 2981 compared to 288, or just about 289. Close to a $100,000 difference there over 20 years. So, yes, I would definitely take option B. When would option A make sense? Well, it would make sense if you're able to get up to $500,000 into the policy in 1 year. The first year would really do it, but if you do it in 2 years, let's say you do it years 1 and 2, and then take your foot off the gas, it would make sense to go with the higher end option. Really, if you're able to redline a policy, meaning max fund it, particularly during 2 years, that's where we'll almost always see the internal rate of return at a very high level, where people look at the policy and say, okay, the numbers are worth it. I'm glad I went with the high-end option because I did take advantage of those limits. I max funded it and I see my money growing. I can access it. It's fun and I love it. When one regrets it is when we go with an option like this. Okay, I think I could get 500K in, but I never hit it. It just doesn't happen. Other expenses come up. I bit off more than I can chew, whatever it might be. Let's look at the Executive Strategies product. Here we go. All 100K base premiums here. This one I'll see a more drastic difference. So specifically, here's 500K, maxing it out. You can tell from the death benefit. Next option, ability to pay up to 500K. You can tell from the death benefit at 10 million. Only paying in $300,000. Now compare that to this, 300K for 5 years, but a lower death benefit. You've got a max of 300K. So no room to add more funds. Break even year 5. Over here, very close to year 5, but it's year 6. Year 20. There we go. Difference there. $40,000 or so. Time passes. It does pull away a little bit more if we were to scroll down. The point is, as we look at the different options, he saw this, and just to kind of begin to conclude this video, he ended up selecting the 500K option with the Executive Strategies product because he feels that he can definitely hit 300K per year, but he can hit 500K really during the first 2 years as he approaches it. That's something he looks at and says, I think I'm going to be able to do that. And if it's not in the first 2 years, I will be able to do it some years. And if he does do that, then it would have made sense to go with that higher end option. Because we don't necessarily, we never want to bite off more than we can chew. But at the same time, the biggest source of buyer's remorse that I've seen from individuals paying in large dollar amounts to policies, 6 figures or greater, I see this a lot when it's $50,000 per year more going into a policy, is we hear, I wish I would have started with a larger policy. And the reason why is what everyone hates about whole life insurance is this red piece we see up front, that negative hit. And this is an Executive Strategies product where it's minimized right out of the gates. But that's what people don't like because it inflicts financial pain. What everyone likes about whole life insurance is every year after the first year. Gets better and better. I get more and more of my money back. I get the internal rate of return. If there is a market crash or anything like that, I continue to see it appreciate. And a lot of times we hear, I'd like to add some more money to the policy. But if I'm already capped out with respect to my MEC limit, well, then what happens? I can't add more to that existing policy and I need a new policy, which in some ways is a good problem to have. And we have a lot of people that do that. And it's always finding that fine line. How do I build enough space, but not going too high and setting it at a number that I never hit because then it hurts me a bit. That's the kind of stuff we talk through and show you the different options. This way I can pick the one that I like the most. We've got the Mass Mutual one as well, but he selected that Guardian Executive Strategies product, one for the upfront cash value. Being a business owner, he likes the idea just as having access to that if he needs or wants it. But also as he looked at the options, he said, okay, the 100K, that I'm confident I can hit. He feels very comfortable about that. For 5 years, not super confident that he can do that all 5 years, but he is confident that he can get the funds into the policy at least 1 or 2 years. And if he does that, we actually walked through over a Zoom call those exact numbers, just plugged it into the software. We had a lot of fun building the policy out together. Saw that and said, okay, I'm comfortable with that option. And then of course we look at the guaranteed values, dividend values. We checked out the indexed rider too with that same product. And his comfort level was there with that particular option. So I hope you enjoyed this one. If you did, please hit the like button, subscribe for more. If you have any questions, feel free to reach out or leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.